This presentation is for Chapter 5, Cost, Volume, Profit Analysis. In Learning Objective 3, we are going to learn how to use cost, volume, profit analysis for profit planning. Let's see how managers use information about cost behavior to make business decisions. Cost, volume, profit, or CVP analysis is a planning tool that looks at the relationships among cost and volume and their effects on profits and losses. Smart Touch Learning could use CVP analysis to estimate how changes in sales prices, variable costs, fixed costs, and volume will affect profits. There are 5 assumptions that are made with cost, volume, profit analysis. First, the price per unit does not change as volume changes. For example, Smart Touch Learning assumes that all tablets will sell for $500 each. Second, managers can classify each cost as variable, fixed, or mixed. Another assumption is that the only factor that affects total cost is change in volume, which increases variable and mixed cost. For example, Smart Touch Learning assumes that the variable cost per tablet is $275. Similarly, it is assumed that fixed costs do not change. In our example, Smart Touch Learning assumes that fixed costs are $13,500 per month. Finally, there are no changes in inventory levels. Smart Touch Learning assumes that the number of tablets produced equals the number of tablets sold. Most businesses do not perfectly meet these general assumptions, so managers regard cost, volume, profit analysis as approximate and not exact. CVP analysis can be used to estimate the amount of sales needed to achieve the break-even point. The break-even point is the sales level at which the company does not earn a profit or a loss, but has operating income of 0. Required sales can be expressed as either a number of units or as a total dollar figure. We are going to look at 3 methods of estimating sales required to break even: the equation approach, contribution margin, and contribution margin ratio approach. The equation approach can be used to estimate the number of units a company needs to sell to achieve target profit or total sales. Looking at this equation, we can see that net sales revenue minus total cost is equal to operating income. We can further break down total cost into its components: variable cost and fixed cost. This slide illustrates how to use the equation approach. How many tablets must Smart Touch Learning sell to break even? If the tablets cost $500 per unit and the variable costs are $275 per unit, then the contribution margin per unit is equal to the difference between those two, which is $225 per unit. We know that the contribution margin minus fixed cost would be equal to the profit. So the fixed cost for this example is $13,500. If we add $13,500 to each side of the equation, we will get the result of $225 per unit times the unit sold is equal to $13,500. Then when we solve for units sold, we would divide $13,500 by $225 per unit, so the units sold to break even would be 60 units. We can prove that is true by plugging back in 60 into the equation. $500 per times 60 units is $30,000. $275 per unit times 60 units is $16,500, and we would subtract that and the fixed cost of $13,500 from $30,000, and we would get operating income of 0. We can take a shortcut method to calculate the required sales to break even using the contribution margin approach. So we just rewrite the equation to derive the following. The required sales in units is equal to the fixed cost plus the target profit divided by contribution margin per unit. So using this formula, we can enter the given amounts to calculate again the required sales in units. So fixed cost of $13,500 plus zero target profit, which is break even, divided by $225 per unit would give us the required sales in units of 60. We can plug that back in to the contribution margin income statement, and we can see net sales revenue minus variable cost of $16,500 would give us contribution margin of $13,500. When we subtract the fixed cost of $13,500, operating income would be zero. We can also use the contribution margin ratio to compute the required sales to break even rather than the units. If you remember, we calculated the contribution margin ratio by taking the unit contribution margin of $225 and dividing it by net sales revenue per unit of $500 per tablet. That gave us contribution margin ratio of 45%. If we take the fixed cost for Smart Touch Learning of $13,500 plus zero target profit at break even and divide that by the contribution margin ratio, we get the required sales in dollars to break even of $30,000. A variation of the break-even point calculation is the target profit calculation. So target profit would just be the operating income that results when net sales revenue minus variable and fixed costs equals management's profit goal. We can use the same three approaches that we use for break-even point to determine the target profit. So this slide shows the calculations to achieve a target profit for Smart Touch Learning of $4,500 using the same information that we used to calculate the break-even point. We can see in the equation approach that after we solve for the units sold, it would be 80 units that are needed to be sold to achieve a target profit of $4,500. Using the contribution margin approach, we can see that we would take our fixed cost of $13,500 plus the $4,500 of target profit, divide that by the $225 per unit contribution margin, and we would still get the same 80 units. Using the contribution margin ratio approach, we would add our total fixed cost of $13,500 plus our target profit of $4,500 and divide by the contribution margin ratio of 45%, and our required sales in dollars to earn our target profit would then be $40,000. We can plug in the 80 units into the contribution margin income statement, and we can see that we would achieve our operating income or target profit of $4,500 with the 80 units that we calculated previously. This exhibit shows a cost volume profit graph. This graph shows how changes in the level of sales will affect profits. As in the variable, fixed, and mixed cost graphs we previously looked at, the volume of units is on the horizontal axis and the dollars are on the vertical axis. To graph the cost volume profit relations for Smart Touch Learning, we draw the sales revenue line, the fixed cost line, and the total cost line. Then we identify the break-even point. The break-even point is where the sales revenue line intersects the total cost line. This is where revenue exactly equals total cost, and in this case it is at the 60 tablets or $30,000 in sales that we calculated previously. Finally, we mark the operating loss area and operating income area on the graph. To the left of the break-even point, total cost exceeds sales revenue, leading to an operating loss. That is indicated by the orange zone. To the right of the break-even point, the business earns a profit because sales revenue exceeds total cost, as shown by the green zone. So graphs like the one in this exhibit are helpful to managers because the managers can use the graphs to prepare quick estimates of the profit or loss earned at different levels of sales. The three target profit formulas are also useful, but they indicate income or loss only for a single sales amount. And that is the conclusion for the presentation for Learning Objective 3.